As with Mr. Everett James. Good morning, sir.
Good morning. How is my reception
Oh,
from the?
it's
Yeah,
great. It sounds like you. It sounds like you're next door.
thanks. Fantastic.
Yes, man. Oh boy. Oh boy. Oh boy. Yeah, yeah. I'm looking forward to your show today. There are a lot of things that's going on. We're in the fourth week of the government shutdown. Is that correct?
That is correct. We're entering the fourth week, and here we are. It won't be long before we're going to be facing the longest. But right now, we are on the 29th, of the month.
Right.
We are now seeing situations really increase in severity as time goes on.
Oh yes, yes, yes. Many Americans will be hurt here if
That's
we
right.
don't resolve this. Now, it's my understanding that during the shutdown, it's costing us $15 billion a day.
Yes, yes,
Okay.
that is correct.
And
Uh,
you multiply 15 billion times 30 days.
yeah,
Well, I think they could pay for any subsidies that that's going to be that needs to be is extended. And I think that if they get back to work, they can solve this today. Say,
yeah.
hey, extend those subsidies and let's go.
But right, that is the case. Unfortunately, there's from the other side of the aisle, extending the subsidies is going to cost a lot of money, which they actually anticipated some time ago as being totally unmanageable. So it's going to be a continued disagreement, which really does need to be solved. But many of the American taxpayers see that as something that is a bad, showing bad judgment, because it's just simply unable for it's not possible for the federal government to support the world's sick people.
Well, okay. Well, that's a topic for or a subject for another show. But I'm going
Right.
to step aside and take a look. I think that can be resolved if we can send $40 billion to Argentina. We can certainly do what we're doing. I mean, we can certainly make sure that Americans can afford their health care. With
That
that,
is
I'm going to step
correct.
aside. I'm going to step aside, sir,
Thank
and
you.
enjoy your show.
Yeah, thank you so much. And thank you, Mr. Brown. This is Everett James, your trusty tax reporter, coming every week at 10 a.m. on the West Coast and 1 p.m. on the East Coast. That we invite your participation. Please, if you have a question or a comment, make it part of the program, and there will be a reward for those who call in with their comments and questions. If the question is posed, and if it's manageable, we will attempt to make every effort. We will make every effort to answer that question in the following week's program. The contact information by phone is 951-522. And if you use internet, evjtax1 at gmail.com. And we will make every effort to repeat that information before the close of the program. Okay, here we are as earlier, um, announced, day 29 of the government shutdown. It's entering its fourth week. The Senate is again expected to vote. The last Senate vote was unsuccessful again, as it was not possible to reach the 60 vote requirement. And so our government is now at a logjam, as unable to move forward without getting approval from both organizations in our federal legislative bodies. Democratic Senator Jeff Merkley has been speaking on the Senate floor for a long period of time to protest the president's policies, and that leaves the timing of a vote this next week uncertain. This current shutdown is only exceeded by the 35-day shutdown in late 2018 and early 2019. So as you can see, we're on day 29, and it won't be long before you reach day 35, which will put us in the unenviable position of being going through the longest number one funding lapse in modern history. The Democratic leaders have asked President Trump for a meeting to negotiate on their health care demands, but President Trump has said that he will only meet with them once the government reopens. And so they're looking for a clean bill before they make any changes in the subsidy situation. Basically, the president has said that Republicans will not be extorted into giving in to the demands from the other side of the aisle. It's amazing that that this is taking place. It is certainly both the House and the Senate have been through this before, and you would have thought that some type of a workable solution would have been carved out in order to prevent this from happening again. But just to keep you up to date, the issue really, truly, is related to our health care subsidies, particularly in the Obamacare Affordable Care Act. First off, the healthcare subsidies really, as many people know, are the key. Well, who's going to lose if those healthcare subsidies expire as planned? Because the enhanced subsidies to pay for health premiums of folks who ordinarily could not afford the increases. The subsidies, will be affecting a lot of people, but of course, the other side of the aisle is standing by, on the belief that the belief that the beneficiaries may include not only citizens but non-citizens. That is, truly the heart of the shutdown fight. As give you an example, Celia Monreal worries every day about the cartilage loss in her husband's knees. And it's not just because it's hard for her to see him in pain, but it's also because she knows soon that their healthcare costs could skyrocket. Monreal, who's 47 years old, and her husband, Jorge, who's 57, rely on the Affordable Care Act marketplace for health coverage. If Congress, of course, doesn't extend certain ACA tax credits, that's Affordable Care Act tax credits, Um, they I said if they don't extend those credits, um, their fully subsidized plan will increase in costs, putting it really totally out of reach. The tax credits that we're focusing on originally were legislatively determined to have an extension only up to the end of this year, of this 2025 year. Um, so there's it is has been fully documented that this is was something that was agreed upon by both sides of the aisle, the Democrat and Republican sides of the aisle. This was agreed upon that the subsidies would expire at the end of this year. So the if that with Congress deadlocked and the open enrollment period for the ACA plans approaching on November 1st in most states, there's a lot of Americans who are left to navigate the unknown. Not extending uh, uh, the Obamacare extensions, not extending that, more than 24 million people, um, including farmers, ranchers, small business owners, and other self employed people who do not have other health insurance options, of course, are going to lose their coverage. The enhanced premium tax credits, um, really, on the other hand, have made costs far more manageable for many of them, allowing some lower income enrollees to get health care with no premiums and higher earners to pay no more than 8.5% of their income. The if those tax credits expire, annual out-of-pocket premiums are expected to increase by 114%. That's an average of over $1,000. That's according to many analysts. While some premium tax credits will remain, the level of support will decrease for most enrollees. Generally, uh, um, the marker um, or the threshold is 400% of the poverty level, and that's around $63,000 per year for a single person. As a result, especially hard hit groups will include a small number of higher earners who will have to pay a lot more without the extra subsidies, and a large number of lower earners who will have to pay a small amount more. With higher premiums, some folks will drop out of health insurance altogether. That's predicted by many analysts. Many younger, healthier people will just have to forego health coverage. The insurance companies will increase costs for members of the covered population to account for them being older and sicker. The change will strain hospitals since more uninsured people will need emergency care they just can't afford. That could lead to uh, drastically lower cash payments and uh, can eventually wind up with the hospitals closing, particularly in the rural areas of the country. If you have less subsidies for people getting health insurance, you're going to have less health coverage and, of course, less health care. That was a remark by Jason Levitas, a senior fellow in the Health Policy Division of the Urban Institutes. People are going to be sicker and they're going to be dying at a higher rate. So this is an issue that has been brewing, for some time. Um, the the question has been raised, though. The economic condition, you know, has shown signs of fully recovering. You know, from the COVID episodes, families are back to work. So why is Washington still pushing billions in subsidies to health insurance companies? These temporary subsidies really were meant as a short-term fix. Instead, they become handouts for insurers while families still face sky-high costs and a record of denied claims. It's really time to prioritize patients over insurance companies. Um, the You know, some people have reported that the reason why Democrats did not make these subsidies permanent when they had the opportunity, when they were in office, when they controlled all of government, it was because it was just so expensive and unaffordable. The So I mean you know it really makes sense that uh, it really makes sense that the extra subsidies, if they expire as expected, you know, will meet the expectations of the majority of the past electorate, our presidential electorate. Um, but these subsidies um, really, in the long run, have created a absolute huge amount of fraud. Um, and that, you know, whenever the government does have a program that subsidizes part of our economy, such as college grants, money grants, whenever the government sets up those special subsidies for special populations, you're going to have, you know, a great deal of higher costs. That's undoubtedly part of the reason for the higher cost of higher education to begin with. The Many folks in the past believed that extending the inflated Obamacare subsidies would be a mistake. It would continue sending billions in dollars to insurance companies, and even for phantom enrollees, as you may have heard, that that there were organizations that were paying folks to become enrolled, and these were folks who did not necessarily need the coverage, but were doing that, you know, to help drive the public need for these extensions, or these extended subsidies. So if the Congress should let these subsidies expire and really focus on real reforms that lower the cost and put patients, not insurers, in charge, you know, of the healthcare market generally. Congress really needs to do a better job by focusing on lower costs and making certain that the costs are being set by in a competitive way in an open market, not by an artificial extension of subsidies. The And as I mentioned before, many people believe that the reasons why the Democrats did not make these subsidies permanent when they had the opportunity and when they were in office is because it was so unbelievably expensive, the bank-breaking expensive. It makes sense that the extra subsidies expire, according to many folks on the other side of the aisle. Obamacare, and by being overly generous in the amounts of the subsidies, is still not going to pay the majority of the medical tab. One of the main results has just been increasing a great deal of misuse of the program, leading to fraud. So that battle continues, and our prayers certainly go out to the many folks who are suffering during this period, particularly those who are no longer employed, and starting off with the federal government, there have been layoffs that have taken place, and certain groups who have been furloughed without pay. And wow, what a time for this to occur, just before the beginning of our Thanksgiving Christmas holiday. This reporter will continue to keep you up to date on this major issue. But in the meantime, let's take a look at what taxpayers will be facing come 3 months from now. After all, this is the beginning of the 2-month countdown period before tax filing for tax year 2025 will begin. And one of the things that determines how much of our income is being going to be taxed, much of it is controlled by a particular measure called the modified adjusted gross income. The IRS and other federal agencies use that MAGI, modified adjusted gross income, to determine eligibility for certain tax breaks. And certainly this was an eligibility marker that was highly important in determining who was eligible for all of the breaks that came with the July 4th signing of the one big beautiful bill that Trump signed. The eligibility for all of those breaks, many of those breaks were are determined by what they call the modified adjusted gross income. The one constant of the modified adjusted gross income is that it always starts with your adjusted gross income. And that's the amount shown on line 11 of the Form 1040 or 1040 SR, which is senior tax return. From here, it gets more complicated by the following very common situations. There's 5 new one big beautiful tax deductions, and the modified computation is used to find out if you actually are eligible for those deductions. The first one is the $6,000 senior deduction for folks aged 65 or older. That's the first one. The second one is that $40,000 limitation on deducting state and local taxes on the Schedule A, the itemized part of the return. And the third one is the new write-offs for up to $12,500 of overtime pay. So that overtime pay is possible to deduct from the deductibility uh, um, category. Fourth one is $25,000 of tips. You can write off up to that amount of $25,000 for tips. And the last one is you can write off up to $10,000 car loan interest. Now, keep in mind, that's not writing off the interest that will be charged related to leases. It's only for the situation where you're actually purchasing, the car. The modified adjusted gross income is the AGI shown on line 11 of the return. And then you have to add any foreign earned income exclusions, foreign housing exclusions, and certain excluded income received from sources in other places such as Puerto Rico, the American Samoa Islands, Guam, or Northern Mariana Islands. Now, regarding the credits, other major credits such as the child tax credit, adoption credit, and American Opportunity Tax Credit, these credits use the same definition of the modified adjusted gross income as we have been discussing. So believe it or not, just to keep you up to date, most folks on Medicare, they pay that basic fee for Medicare B coverage, which, by the way, for 2025 has now risen to $185 a month. That's incredible. Let's take a look at some of the tax areas that you may or may not be eligible for to deduct on your 2025 tax return, and start either looking for the areas of your financial life which might yield a tax deduction, or develop one before the end of this year. We will be this program will be mentioning these tax areas for possible deduction, and so it means that you do need to do a review of your own personal financial situation to see if any of the tax breaks that were covered in the one big beautiful bill signed by Trump and back in on July 4th of this year, if any of your financial activities fit into these possible tax deduction areas. There are so many. If you are, for example, planning to adopt, or planning, adopting, or actually in the process of adopting a child, you may qualify for a tax credit. The adoption credit is taken on up to $17,280 of qualified expenses per eligible child in 2025. So if you are in that process of adopting, start pulling together your receipts and expenses that you had to deal with in order to qualify for that credit. The amount for next year for 2026 will be $17,670. And as you will find out, the qualified expenses include adoption fees, court costs, legal expenses, travel expenses, meals, and other expenses directly related to the illegal adoption of a child. The full credit is actually available for special needs adoptions, even if the special needs adoptions cost less. Um, it starts phasing out for filers with modified adjusted gross incomes of over $259,000. You can easily find out the other for the amounts that are deductible by consulting with your tax preparer or tax advisor, or going online to look up those how it affects other types of filers. So the it's interesting that IRS does have they do provide a lot of guidance on in the form of frequently asked questions, and you can rely on the FAQ frequently asked questions to escape penalties, and many people have used that as a way to avoid or escape from any penalties that are due to accuracy of your return. The FAQ, the frequently asked questions, do not rise to the level of legal authority, and you cannot use them as precedents to support the merits of your case. But folks who can demonstrate that they relied on the frequently asked questions in good faith, and that such reliance was reasonable based on the facts and circumstances, you do have a reasonable cause defense, and it won't be subject to you will not be subject to any negligence penalties or other accuracy related penalties. Folks, are there folks out there who are planning or even in the process now of shuttering or closing your struggling business? Well, don't forget taxes. Check out the IRS's Closing a Business page on the agency website. It has information and procedures for sole proprietors, partnerships, corporations. Among the to-do things, file a final return. Make certain that you identify that your return as a final return, and pay the taxes. Check out the rules for terminating a retirement plan. Pay all employees and independent contractors. Cancel your employer identification number. And by all means, keep your tax records and your payroll records. Some side information that you might be interested in. Despite this government shutdown, filings of tax and payments are not delayed. There were returns that have been sent in on the extension that was due this past October 15th. If you received a notice of deficiency from IRS and you want to fight it out in tax court, you must file a petition to go to court within 90 days. Now, although the tax court has now halted trial sessions, it's still accepting filings. And if you received an automated collection letter from IRS, you need to respond by the due date. But really do not expect to hear anything soon because their IRS has a mail backlog that is growing every day. IRS will not pay tax refunds to some filers during the shutdown. So let me repeat that. they will not be paying tax refunds to some filers during the shutdown. Individuals who electronically file error-free 1040s and requested a direct deposit refund will get their money on a timely basis. But all other filers who do not follow many of the rules will have a delay until this shutdown ends. I guess that's just makes common sense. For your general information, running IRS and the entire Treasury Department certainly has been shown to be too much work for just one person. At least that's what Treasury Secretary Scott Bessent probably figured out. In August, then IRS Commissioner Billy Long left the agency after less than 2 months on the job. And then Bessent took over as acting commissioner, doing double duty. Well, in early October, Bessent created a new position at the IRS, a new chief executive officer, that was Frank Bisignano, if I'm pronouncing his name correctly. Frank Bisignano was named to be the new CEO role. So Bisignano will oversee all day-to-day operations at the IRS agency, essentially acting as a de facto commissioner. That's according to what longtime IRS observers have commented about. Now, he isn't giving up on his Social Security Administration role. Instead, he is now in charge of both Social Security Administration and the IRS. He's now the 8th person since January 2025 to take the reins at the service. So now we have been focusing on the Obamacare tax credits. And of course, as we mentioned, that is the central sticking point in this ongoing government shutdown battle. In actuality and in tax filings, the form, the premium that is being sought after and it has been enhanced, the premium tax credit is what what some people are looking for. And that tax credit is available to eligible individuals who actually buy insurance through the marketplace. Folks who can get affordable health coverage through their employer don't qualify for the premium tax credit. So again, what is used through the availability of the Affordable Care Act coverage is what's called the premium tax credit, PTC. And that's only if you buy insurance through the marketplace. And as again, I want to mention that folks, some people are not eligible for the PTC, premium tax credit, if they can get health credit through their employer. Also, folks who are eligible for Medicare cannot get the premium tax credit. And folks who are being covered by TRICARE, that's what they use for military folks, military service people. If you qualify, if you're eligible for Medicaid or other federal insurance programs, you're not going to qualify for the premium tax credit. Not surprisingly, the premium easing up on this premium tax credits is not a goal of President Trump or of congressional Republicans. Even while GOP lawmakers in DC are hard at work trying to negotiate a tax deal to extend provisions in the 2017 Tax Cuts and Jobs Act, there is silence on the premium tax credit. Most tax and healthcare experts agree that renewing the premium tax credit enhancements just isn't in the cards. And of course, that's to the chagrin of Democrats. How does the premium tax credit work? Well, it's estimated that when you go on the marketplace to buy insurance, that's when you'll get your first lesson on using the tax credits. The estimated credit for 2026 is based on the expected 2026 income. So you begin with your 2024 modified adjusted gross income, and then you add or subtract any expected income changes that you anticipate having for 2026. The lower your modified adjusted gross income, the bigger the premium tax credit. Most people who qualify for the premium tax credit generally opt to have it paid in advance directly to the health insurance company, and that lowers their monthly premium payments. Now, if you opt for this, you have to file a federal tax return, even though your income may be below the filing threshold, or even if you expect a refund. So again, if you opt for this, opt for that premium tax credit, you have to file a federal tax return, and that's even if your income may be below that filing threshold, or even if you expect a refund. So what you're going to need to do is attach a Form 8962 to reconcile the advances paid to your insurance company and your actual premium tax credit. If the premium tax credit is higher, then you can claim the excess credit on your 1040. If the premium tax credit is less than the advances, most people will need to repay part or all of the excess. The erroneous reporting of that premium tax credit followed the rule. It's easy for the rules for that. It's easy for IRS to catch. They've got their computers set up at the flag file tax returns showing modified AGIs that exceed the limit to take the premium tax credit. So if you, as I say, your modified adjusted gross income exceeds that limit, you're not allowed to take that premium tax credit. So double check that you qualify for it and that you accurately report it. I would say if all folks out in the listening audience who may be using the premium tax credit, I would certainly advise consulting with and checking with your tax preparer to make certain that that is done correctly. So now for all of us who are beginning to consider the health insurance alternatives for 2026, the one option to when you're considering how you're going to manage those premiums is a health savings account, HSA, health savings accounts. What are some of the benefits? They're tax advantaged arrangements, and they're used to manage health insurance deductibles and help to manage out-of-pocket expenses that let you save for your future health care expenses. A lot of employers have a health savings account in their programs. If your employer does not offer this choice, or you are not employed, check with a brokerage company or a financial institution on whether you can meet their rules to fund and keep an HSA for yourself or your family. The health savings accounts have a number of major federal tax benefits that owners can enjoy. Their contributions are deductible, and can be taken from pre-tax wages. But there's a limit for the 2026 or for 2026. The annual limitation on deductible or pre-tax health savings account contributions is $4,400, and that's for self-only coverage. And if you're in a family and you want to cover the family, that limit is $8,750 for family coverage. Folks who are 55 or older can contribute an additional $1,000 into their health savings accounts. It looks as though the tax code has been definitely amended in many cases to acknowledge the additional struggles of folks who are in their older tax brackets. And generally that the age is 55 or older. If you meet that standard, you get additional breaks in the tax code. The earnings inside a health savings account, they build up tax-free for the account owner. HSAs, health savings accounts, do not have a use it or lose it rule, and that's unlike flexible spending accounts. And any withdrawals that are used to pay medical expenses are not taxed. That's the beauty of it. Eligibility for the health savings accounts is restricted. You must have a high deductible health plan to qualify. The minimum allowable deductible for 2026 is going to be $1,700 for self-only coverage, $3,400 for family coverage. So also out-of-pocket costs, including co-payments, cannot exceed $8,500 for self-only coverage and $17,000 for family coverage in 2026. Folks who are eligible for Medicare do not have, they don't have don't have a high deductible health plan. They cannot contribute to health savings accounts. So if you have a balance in an existing health savings account, once you turn 65, you can use that money on a tax-free basis to pay Part B and D premiums. And you can take tax-free payouts from your health savings accounts for your out-of-pocket medical costs, even if you're on Medicare. So, folks, if you are looking for information on setting up a 501(c)(3) tax-exempt organization, the IRS does have a whole bunch of online videos and courses directly benefiting tax-exempt charities. They explain the basic rules, how to apply for an exemption, and other, the important issues that people who set up or manage tax-exempt organizations should know about. What are some of the specific topics? Well, for example, filing the annual Form 990, employment taxes, unrelated business income, gaming, and the ban on political campaign intervention. So in order to get some of those guides, please consult at www.stayexempt.irs.gov. I'll repeat that again, www.stayexempt.irs.gov. stayexempt.irs.gov, where you'll find many videos and other tools to access and possibly become covered, as a tax exempt organization. And here's a reminder for folks who may have received special tax treatments as a result of the damages, money damages, or settlement awards. Proceeds received for physical injuries or physical illnesses are tax-free. Again, which are the ones that are tax-free? And that's for money that you received because of physical injuries or physical illnesses. That doesn't have to include damages received for emotional distress, however, are taxable, with two exceptions. Amounts paid for mental anguish that arise from physical injuries are tax-free. The same goes for reimbursements for medical treatment of emotional trauma. But again, on audit, the IRS agents are looking at court petitions, complaints, or a claim that was filed. And it has to, if it shows the original grounds for the lawsuit, auditors will review the settlement agreement to see how the document characterizes the amounts paid and received by the parties. But again, the proceeds received for physical injuries or physical illnesses receive tax-free treatment. However, if it's money you receive for emotional distress, that is 100% taxable. And with those two, definite exceptions. Amounts paid for mental anguish that arise from physical injuries are tax-free. And the same goes for reimbursements for medical treatment of emotional trauma. The financial disabilities can be grounds for allowing a late filed refund return. Well, the general 3-year statute of limitation for seeking a refund is extended to certain cases for folks who are unable to manage their financial affairs. And that's because they have a medical diagnosis, serious long-term physical or mental impairments. To prove that financial disability, you have to submit 2 documents with your refund claim. You have to submit a physician's statement that meets certain rules, and a document that no other person was authorized to act on your behalf in financial matters during your disability. Just to keep you up to date, proving eligibility for a return that you may have filed late, proving that eligibility is not easy. As in one particular case that we'll share with you, a woman was due a refund because of over withheld income taxes for 2017. She did not file her 2017 form, until November of 2021, almost about 4 years later. She alleged that she had a work injury, lost her job, and lost her health insurance, and was going through eviction proceedings. Well, even though her life was full of misfortune and real financial handicaps, she didn't submit that the 2 required statements with her income tax filing, but instead gave them to an IRS employee during the administrative appeals process. Well, in addition, the doctor's statement said she suffered from hypertension and sleep disturbance. Unfortunately, that was insufficient for the to get her by the IRS limitations. And do you need to fine tune your withholding and estimated tax payments? I can't tell you, as a practitioner, of how many times folks, get a good hint or are brought up to date with their tax advisors that they're simply not having sufficient funds withheld from their paycheck to meet the estimated tax payments for the current filing year. And the need to get to your bookkeeper at your job to have a new withholding estimator made out. IRS does have a withholding estimator on the website to help you figure that out, whether you're having the right amount withheld from wages, pensions, IRS distributions, and the like. But the IRS tool does ask about various sources of income, and it does give tips on credits and deductions. And it estimates how much withholding to actually request. Folks can give their employers a new W-4 form to have more tax withheld. Folks receiving pensions or annuity payments can submit form W-4P. IRA owners use form W-4R. And Social Security recipients can fill out a form W-4V. The folks who are taking required minimum distributions from IRAs can use a withholding tax strategy, have more income taxes withheld from your year-end distributions from your traditional IRAs. Tax withheld at any point in the year is treated as if evenly paid throughout the year. By default, IRA custodians withhold 10%, but you can always ask for more to be withheld. That's one thing that I have learned as a tax practitioner, that folks seem to be, they feel that somehow that amount that is being withheld is the correct amount. Well, perhaps it's not, but it can be changed. So we, just to keep you up to date, you will recall the Inflation Reduction Act that was passed under the Biden administration. Over half of that Inflation Reduction Act windfall is gone. That was clawed back by Congress over the 3 years since enactment in 2022. The Inflation Reduction Act gave IRS $80 billion in additional funding over 10 years, with $46 billion targeted for enforcement, and the rest split between modernization, operations support, and taxpayer service. Well, Congress has since rescinded $42 billion of the enforcement funds, and the IRS has so far spent $9 billion of its IRA money. And pardon me for the unexpected burp that just took place a few seconds ago. With the fact that Congress has rescinded all that money, look for Congress to try to rescind even more money sometime this year. Okay, if you have a tax that you owe, wise counsel would be to timely file your return or extension and pay what you can. And then look into applying for an online payment plan. See if you're eligible to submit an offer and compromise. Now, the offer and compromise is complicated in some way, so please contact your tax advisor. Do not try to do it without some help and counseling. So, if you're experiencing financial hardship, contact IRS to request a temporary collection delay until your financial condition improves. So, it always helps to contact the folks who are demanding the money. And there are two online payment plans. If you owe less than the $100,000 in taxes, penalties, and interest, you can set up a short-term plan online to pay within 180 days. If you owe 50,000 or less, you can set up an online long-term installment agreement. And remember that if you file a delinquent return or pay taxes late, you may qualify for a penalty waiver under the IRS's first-time abatement policy. They will approve a waiver of the late filing and late payment penalties for filers who pay or agree to pay the tax due and have been tax compliant over the past 3 years. So the penalties for late payroll tax deposit and delinquent returns of S corporations or partnership are also eligible for the waiver if conditions are satisfied. But the estimated tax payment penalty doesn't qualify for this payment abatement program. The IRS doesn't give it automatically. If you get a notice with penalty charges, you can call the number on the letter and request relief from IRS penalties. Or you can mail a statement on a Form 843. Okay, folks, it looks as though the time for our update has been completed. And keep in mind for your involvement in our program, please call 951-522-9877 or send us an email at evjtax1@gmail.com. Thanks again, and we'll see you next Wednesday.
All right, Ev. Thank you so much for that information. And
Right.
guys, make sure you come back tonight, 8:15 p.m. for Cultural Excellence. 8:15 on the East, 5:15 p.m. your time, Ev. All right, let's do it. All right,
Thank
guys,
you.
enjoy your Wednesday.
Thank you.